Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Salesforce issuing a better than expected revenue forecast. We'll dig into what's driving the software giant's outlook. Plus, we hone in on the economic risks facing the U.S. economy. And we'll talk winners and losers of AI as competition heats up. Let's take a look at what's going on for the major averages here. Not much change today. Kind of a tepid day when it comes to trading action. We've got the Dow down about 42 points. It's not even 0.1% move. Similar with the S&P 500. The NASDAQ is off by about 0.1%. So not seeing big moves there. We continue to watch what's going on in the bond market ahead of the Fed's decision next week, a week from yesterday, and we are seeing a little bit of a bump up in yields here today, 4.09%, although we know the broad expectation is that the Fed is going to cut rates. We also continue to watch what's going on with Bitcoin here. It's back above 91,000, so definitely has seen some recovery from some of that recent volatility. Gold, meanwhile, today is very little change. So quiet day on the broad front. So let's zoom in and look at Salesforce. Salesforce is getting a muted but positive reaction from the street after reporting earnings for the third quarter. Earlier, the shares were up much more. Now they're only up 1/5%. The software giant did tout a huge 330% year-over-year growth of its AI Agentforce business. But put it in perspective here. Total revenue for that segment, annual recurring revenue, was just over $500 million as it attempts to find a place in the AI trade. Here with more, Angelo Zeno, CFRA Research Senior Vice President and Equity Analyst. Great to see you, Angelo. So I want to talk a little bit about this stock action, first of all, because it is interesting. It saw a little more positive. This was seen sort of initially as, okay, they're starting to make some progress here on the AI front, but now the shares are barely higher. What do you think the sort of second blush read here is?
Yeah, Julie, and thanks for having me. When you kind of look at the shares here, I mean, you're right. I mean, it had a nice pop here after hours. You actually look at the quarter, the numbers, I thought it was a pretty good quarter overall. As far as the top line numbers are concerned in the actual October quarter, relatively in line. But when you actually kind of start drilling down, you gave some of the Agentforce numbers, and that's really what the street is eyeing at this point in time. They want to see more momentum coming from their AI offerings. And we saw really good sequential growth from Agentforce of north of 50%, increase sequentially in terms of the bookings and even some nice usage numbers in terms of the tokens generated here from Agentforce. The problem is you alluded to those numbers there, which were great, and the year-over-year increases, but they're coming off very, very low numbers, right? And despite the fact that you're signing these contracts and these bookings, the problem is it's going to take time before you actually ramp up, right? I mean, you're getting these contracts signed. You're now going to have to, get the users actually creating these agents, start testing them out, and before you actually fully ramp these new customers, it'll take several quarters out. In the meantime, you've got this kind of bearish, negative commentary on the broader SaaS landscape, which is why you're seeing these, profit taking on any type of, pop in the shares.
Well, okay, so let's take that part of it, right? Because, the broader SaaS landscape, software as a service, is most of their business, as you point out, right? People are betting on the growth of this still relatively, on a relative basis, small part of the business. So what is happening with the broader SaaS spending landscape, and what effect is that having on Salesforce?
Well, listen, we've seen overall SaaS growth trends decelerate, for the last 2+ years. I mean, in a post-pandemic world, there's definitely, I'd say a bit up in terms of purchases during the pandemic. You're now kind of in this environment where growth rates have decelerated. A number of factors are definitely going on here. You're getting more enterprises that have to scrutinize their budgets and find exactly how they want to leverage their spending. And specifically, they are spending more on AI, but SaaS vendors have to compete against potentially, a number of these enterprises basically, taking these models and having a do-it-yourself approach internally. You're, of course, having, a landscape where the jobs market, the jobs picture isn't as great as maybe one would hope for. And as a result, seat growth comes into question here, especially as AI productivity improvements continue to take place here over the next couple of years. So you have those headwinds and uncertainties about the SaaS landscape really kind of really, taking center stage. And given the uncertainties there in the market, the street really is taking a wait and see approach across the entire SaaS landscape.
And that's evident certainly in the action we've seen in the shares year to date, Angelo, right? So, yeah. I mean, you would think with that backdrop, it would be easier for us to see a pop in the shares. So the fact that we're not, I mean, what does that say about sentiment around this name?
Well, ironically, this is an environment where maybe I think valuations just don't matter that much, right? I mean, you actually look at the valuation of this company, and it's really trading at all-time lows. It's trading about 16 times our 2027 estimate. And, especially when you start thinking about the fairly decent growth rates. I mean, not to the levels that we've seen in the past, but if this is a company that on an organic basis can, let's call it, grow high single digit, probably about 11-12% here over the next year with the Informatica acquisition. And then thereafter, I mean, even if you're thinking of a potential rule of 50 thumb by the end of the decade, which is what Salesforce has alluded to, you would think it warrants a multiple better than that. And our view is at some point, if this will be all about a show me story, if they actually start showing the street that they can gain that momentum on the AI front, which we think they will, I think that the sentiment starts to turn. Exactly how long that takes, I think, is the big question mark out there.
Yeah, but that's why you guys still have a strong buy rating on this stock, I assume.
Right.
But that sort of combination of the valuation being low and you believing that eventually they'll get there on the AI front.
Yeah, we think the earnings power is still going to be there. And again, that multiple compression we think is a buying opportunity. And again, it's all going to be on timing. And at this point in time, it's all about the execution. So our view is you're going to continue to see the great Asian force type numbers that we just saw this quarter. And that momentum will kind of continue to evolve here over the next couple of quarters. But again, when you start thinking about the size of it right now, 4 to 5% of sales, you kind of need to get closer to at least high single digit to 10% of sales, maybe before it starts making some noise and gets some on the street enthusiastic about the name.
Angelo, I got to ask you about Mark Benioff because, listen, the guy's always outspoken, right? But his outspokenness over the last few months has changed tenor. And I wonder if that is a risk for the company at all.
I mean, it could be. I mean, you get what you get with Benioff and Salesforce. And I think at this point in time, right, investors know that. But yeah, I mean, when you've got an outspoken CEO like Benioff, and there are others out there, of course, there's always that risk. But at this point in time, I mean, listen, Benioff has done an absolutely phenomenal job with Salesforce. It'll be interesting to whether or not he can actually make the pivot here in terms of becoming a true AI-oriented company. But that said, I mean, I think investors right now shouldn't be worried too much about Benioff and his tactics.
Angelo, good to see you. Thanks so much for joining us.
All right, thanks for having me, Julie.
Coming up next, we'll have an outlook for fixed income in 2026. Stay tuned.
Welcome back to Yahoo Finance. I'm Brooke DePalma live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Snowflake, Five Below, and airline stocks. First up, AI data cloud provider Snowflake. That stock falling today after revenue guidance fell short of the street's expectations, even though it deepened its partnership with Anthropic. Despite that, though, 13 firms raised their price target on the stock, including Stifel, JP Morgan, and TD Cowen. Derek Wood, he's the analyst at TD Cowen. He told clients in a note, quote, "We remain bullish on Snowflake's positioning in the data layer with access to first and third-party data that is used to feed large language models and power new agentic use cases." Keep in mind the average price target on the street is now $285. Next up, we're watching shares of Five Below because Telsey Advisory Group upgraded its price target on the stock to $195, up from $170. That's after the discount retailer posted a really strong third quarter that blew past Wall Street's expectations. In the third quarter, it saw same-store sales growth of 14.3%, and that was boosted by both traffic as well as a higher average ticket size. Now, it also raised its earnings guidance. And analyst Joe Feldman over at Telsey Advisory Group said that Five Below should benefit from healthy consumer demand as consumers continue to seek out value. He also said that tariffs remain a headwind for the company, but it's managing them efficiently. And last up, let's take a look at airline stocks because Citi initiated coverage on Delta, American Airlines, and United, all with a buy rating. Now, the analyst said he believes that the U.S. airline industry is heading into a super majors super cycle, and those three airlines have successfully wrapped a new style of travel business model around a unique set of assets that no existing competitor or newcomer can easily recreate. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Netflix, Hormel, and Canadian bank stocks. First up, Netflix. Those shares are dropping. CNBC reporting the streaming giant is in the lead to purchase Warner Brothers. According to those sources, Netflix would be offering 85% cash for the media giant. Meanwhile, Paramount is reported to have offered 100% cash for its bid. The third bidder for the company, Comcast, there's no update on that offer at this time. All those stocks are trading lower. Next up, Hormel, the food company behind Planters, Skippy, and Spam, posted better than feared results. It logged higher sales in its fiscal fourth quarter, but swung to a loss in the period amid inflation pressures. Still, the company aims to improve profitability and expects better earnings next year. Its revised outlook assumes net sales growth across each of its business units, despite a tough consumer environment. And Canadian bank stocks, TD, BMO, and CIBC, they all beat earnings estimates and saw strong performance in their capital markets divisions. The banks also posted stable credit trends with no outsized surprises on loan loss provisions. The solid results continue a trend seen by other Canadian lenders. That was driven by more advisory work and stable markets. Coming up, we'll handicap potential moves by the Fed and how they could affect the fixed income market in 2026. Stay tuned, you're watching Market Catalyst. Mixed bag of economic data recently has odds leaning toward the Fed cutting interest rates next week. The forecast for January and beyond, that's less certain. Here with me at the desk to discuss what this means for the fixed income market is Colin Martin, Schwab Center for Financial Research Fixed Income Strategist, friend of the show, back with us here. And we're all trying to figure out what's going to happen next year here. You guys think that there will be 2, maybe 3 more cuts. You talk about 3% as like the floor for where they're going. Why is that?
We just don't think there's too much of a need right now to cut more aggressively. And we don't think they even need to cut much further from here. When we say 2 or 3, that's including the likely cut next week, which means probably 2 more sometime in 2026. But right now, obviously all our eyes are on the labor market, but inflation is still too high. I think that's really something that we know that there's a lot of Fed officials who are a little bit nervous about that. And as this year ends, we get a new rotation of voters in there. A lot of the incoming voters have voiced their concerns about sticky inflation. So we think that should slow down the pace of rate cuts a little bit. And absent a recession, that's the really big key right now. Absent a significant slowdown where the Fed needs to cut to stimulate, we think 3% should be that floor.
It feels like the wild card here might be Kevin Hassett. If he indeed is picked as the next chair of the Federal Reserve, and it looks like he probably will be, what is the risk that he's going to cut as far as the eye can see, because that's what the president wants him to do?
Very low risk, I should say.
Why is that low risk?
He's just one vote. So this is the way we're looking at it right now, and there's so many moving parts with Stephen Miran. He's done after this month.
Right.
Lisa Cook is still there, and Fed Chair Powell is still a governor for now, and he's been very tight-lipped about what his plans are going to be. It's really interesting. So this is just one new governor who may or may not be the Fed chair come middle of next year. It's just one vote, and the math doesn't change much, knowing that he will be replacing just another Uber Dove. If the administration or the Supreme Court rules that Lisa Cook could be fired, and if Fed Chair Powell does actually retire when his chair term ends, then I'd say all bets are off, because we'll probably see more dovish members in there. But just with Kevin Hassett, I don't think it changes too much. Unfortunately, as someone who really values the Fed independence, it's kind of made a lot of officials kind of, I wouldn't say be political, but be more outspoken about what their views are. And I think he's going to have a hard time building consensus. That's really what the Fed chair is does well. I think Powell's done a really good job there. But at the end of the day, he's just one vote.
Right.
So next year, I think we'll see a lot of dissents probably, maybe in multiple directions. Unanimous decisions or one or two dissents are probably not what we're going to see. But just having Hassett in doesn't change the math for us right now.
Okay, but we'll see if that changes. So definitely watch this space, I think. The other thing that I think is really interesting is that even if the Fed cuts, it doesn't automatically mean that rates are all going to go down, and especially across the yield curve, right, on the longer end. And I know something that you're watching, and I also noticed it, by the way, this morning in Apollo's Torsten Slok, his top risks for next year. One of them is supply of treasuries and bonds out there. So talk me through how you're thinking about that too.
That's great. He's great. He must be reading our outlook.
He must be.
I'm flattered that we share the same view. But that's a big concern. We have two key concerns that we're not really worried that long-term yields are going to surge higher from here, but that they can stay around the 4% area with upside to maybe 4.5%. One is inflation. It's just too sticky, too high. And we think investors, knowing that we have this supply issues, might just demand higher yields even as the Fed cuts. Because let's say the Fed cuts to that 3% area, in a 3% inflationary environment, we're getting very close to negative real rates. So we think inflation, but those supply issues. Deficits aren't going away anytime soon. We've already seen our debt continue to rise this year. There doesn't appear to be an end in sight, but it's not just with treasuries. We're seeing a lot of corporate bond issuance, specifically with investment grade issuers, with the AI build out. We're even seeing a lot of municipal bond issuance, which is not something we've seen for years. They've kind of held steady. 2025 was a big year. We're expecting another big year next year. So we have a lot of issuance, and you need to find buyers for that debt. So again, not concerned. I don't want to be too concerned or scare anyone that we're going to see a 5, 6, 7% 10-year treasury. But we think that should limit the downside with potential, bumps up maybe to 4.5% or so.
Well, and that also means that all these people who are waiting for mortgage rates to go down to come into the housing market, maybe they're not going to come down that much.
Yeah, I hate to be the bearer of bad news. I mean, maybe a little bit. Now, one thing, it's not just the direction of treasury yields, 10-year treasury yields matters, but also spread. Mm-hmm. Now, the spread is still a little bit high, so maybe we can see them come down a little bit, even if the 10-year treasury yield kind of holds around 4%. But with our outlook for it to kind of hold steady here, we're not expecting to see mortgage rates, significantly fall lower.
Gotcha. Okay, so let's talk about strategy for fixed income investors for next year. And I thought it was really interesting what happened this year in terms of what did well. Emerging market debt did the best. What happens next year? Where should people be looking?
It's a very bond boring outlook, but we like high quality and intermediate term maturity. So we always want to look at what's our interest rate view, what's our credit risk view. So on interest rate risk, intermediate term maturities, we think that's just a nice balance. If you're focusing too much on short term investments, you have reinvestment risk. Even though we only expect 2 or 3 rate cuts, that still is lower yields, lower income as those rate cuts materialize. On the long end, maybe we're wrong and yields do rise a little bit higher if our outlook doesn't come to fruition. And that's always a bad outcome. A lot of individual investors don't fully grasp the volatility of long-term bonds. Treasuries are considered safe, but if you have a long-term bond, you can see large price swings. So we like kind of the belly of the curve as a nice balance there. Mm-hmm. And for credit quality, a lot of that comes down to just valuations. What are we being paid as investors to take a little bit more risk? And you're just not being paid too well in the riskier parts of the market. So, high quality investment grade investments like corporates, municipal bonds, mortgage-backed securities could be an opportunity, but we're not suggesting investors take too much risk.
Colin, I'm really curious. We have seen an explosion in recent years in bond ETFs, fixed income ETFs, of all different kinds, but especially actively managed fixed income ETFs. Traditionally, the fixed income market has not been a place where retail investors have actively played that much, right? Is that changing with those ETFs, or is it still mostly institutionals, investors who are investing in those?
No, we're seeing individual investors go to ETFs, and there's pros and cons to every approach to bond investing. I think a benefit of ETFs is that it opens it up for investors who might not have the largest dollar amount to invest. That's always been something that prohibits investors. $1,000 par values, but a lot of times you want to buy more than that for liquidity purposes. So it's really hard to build a diversified portfolio at a low cost. And ETFs can offer that.
Right.
A tricky thing with ETFs, though, is that there's for most ETFs, no defined maturity date. So you kind of lose that predictable value at maturity. But they can be a good way to get a nice diversified portfolio with a steady income stream.
Gotcha. Thanks so much. Good to see you.
Thank you for having me.
Coming up, we'll have the regulatory outlook for crypto in 2026 and what that means for Bitcoin's price. Stay tuned. You're watching Market Catalysts. Bitcoin continuing to see price swings after hitting an all-time high in October. Yahoo Finance's Josh Lipton spoke to Paul Graywall, Coinbase Chief Legal Officer, about the regulatory backdrop.
Paul, it is great to see you. We've got a lot of crypto news to cover, Paul, and you are just the man to talk about it. Well, let's start with your boss, Paul. Coinbase CEO Brian Armstrong. He's at the Deal Book conference today, Paul. You saw this. He says he hopes for a Senate vote soon on the Clarity Act. Let's start there, Paul. Remind us what the Clarity Act is all about and what it would mean, Paul, for Coinbase, for your business, for the broader industry.
Well, it's great to be here. The Senate is considering their version of the Clarity Act. And what the Clarity Act, which passed the House early this year, would provide for the first time is a true market structure for crypto here in the United States. Now, earlier in the year, Congress passed and the president signed a bill regarding stablecoins, which is an important first step in providing clarity and certainty under the law for crypto and digital assets. But it's really time, it's essential that Congress finish the job. And that's what it will do when the Senate finally passes market structure legislation in short order and the president signs it.
Paul, you mentioned stablecoins there. Now, Brian Armstrong also did talk about that. He said banks are exploring stablecoins after Congress passed the Genius Act. I'm curious, Paul, what does that mean, do you think, for the adoption curve?
Well, there's no question that traditional financial institutions, including banks, now understand very well the power and the potential of stablecoins to bring transformation to the financial services industry. And what it will mean, of course, is greater adoption, greater utilization, and improved efficiency throughout the financial system. We are pleased to see banks finally wake up to the realization that it's time for innovation in the way we move money around on the internet, and we're delighted to have them as partners in this space and look forward to their full participation.
Now, Paul, it wasn't just Brian Armstrong, your colleague at Deal Book. We had Larry Fink there, too. Here's another big name. He said Bitcoin, that was interesting, he said Bitcoin remains heavily influenced, Mr. Fink says, by leverage players. And I'm curious what you make of that, Paul. I mean, how much risk does leverage sort of still pose here? And how does Coinbase mitigate that?
Well, Coinbase has provided access to Bitcoin for millions of Americans, really going back to the earliest days of crypto. But it's a market like any other market that evolves with time, and it's natural to expect that individuals who may have been less familiar or even less comfortable custodying their own Bitcoin and holding it in their own wallets would want to rely upon intermediaries of all types in order to fully participate and finally participate in this market. We are seeing leverage and additional intermediaries relying upon leverage introduce new options for consumers to participate in the Bitcoin revolution. And that, of course, will require there to be new standards, new requirements, and new safeguards put in place. But we think that the market structure legislation is key to facilitating that. It will define for the first time which assets are subject to the securities laws of the U.S. and which assets fall outside of those laws. And we think that concerns regarding leverage and many others are best addressed by Congress and the agencies charged with writing rules once Congress acts.
Switching gears, Paul, another big headline in your world. You saw this one. Vanguard will now allow crypto ETFs on its platform. Curious, Paul, what did you make of that headline? What does it perhaps signal to you more broadly about crypto as an asset class? Why do you think, Paul, Vanguard did an about face there?
Well, Vanguard, like many others, I think initially was skeptical of the power and the potential of crypto to fundamentally transform the financial system and financial institutions that operate within it. And yet I think it's finally become clear to all skeptics that millions and millions of Americans want crypto in their financial future and want real alternatives to a traditional system that has excluded many of them for far too long. And so if skeptics, at least initial skeptics, are finally waking up to that realization and eager to join the party, we say welcome.
Finally, Paul, you all did release the Coinbase Transparency Report. I want to dive into that with you as well. Here's a stat that jumps out, Paul. You also saw a nearly 20% jump in government information requests this year, and more than half coming from outside the U.S. Walk me through that jump, Paul. What explains that? I mean, I would assume it's sort of, it's multifactorial, but is that greater adoption, Paul? Is that, hey, law enforcement, both here and overseas, is getting more sophisticated? What's going on?
Well, our transparency report that we shared earlier this week was, in fact, the 7th report Coinbase has issued detailing the volumes and the sources of all the legal process to which we have responded over the previous year. And it isn't, I think, pretty striking that we now have a majority of those formal requests from law enforcement coming from outside the U.S., even as volumes, as you point out, are continuing to grow in every jurisdiction. I think it's quite natural and quite expected that as many more people, not just here in the United States, but all over the world, are embracing digital assets and cryptocurrencies as a part of their financial future, that law enforcement, in support of governments all over the world, are naturally going to be looking at where, in limited instances, those accounts or those currencies are being used for illicit purposes. We've always taken the position that our customers' privacy comes first, and so we've insisted upon lawful process, but when we are served with it, we will, of course, comply with all laws, and I think our report shows that.
Finally, Paul, I'll get you out of this as we kind of spin ahead, as we look to next year. I'm just curious, Paul, what are some of the metrics you all watch to sort of track and measure crypto adoption? I'm just curious, what's on your radar? Do you watch, is it ETF flows, Paul? Is it stablecoin volumes? What would be on your radar?
Well, it's very, I think, tempting to focus entirely on the price of Bitcoin or some other digital asset or another, or the total market value for all digital assets. But at Coinbase, we are as much interested in the ways in which crypto is being used to power our financial future as much as the dollars and cents of it all. And what we are most excited about is that you're now seeing digital assets and blockchain networks being used to solve many more problems than simple investment opportunities for our customers and for users all over the world. You're seeing real alternatives being made available through DeFi applications, for example, for credit. You're seeing adoption of digital assets to offer many more forms of payment and many more ways to transfer value across the internet. And so it's that real acceleration and adoption of different forms of digital assets and blockchain networks that has us as excited as much as anything. And we're prepared for it, we're excited about it, and we're delighted to see this vision of ours finally come into reality.
Coming up, a new report from the Gates Foundation outlines ways to reduce child deaths around the world. My interview with the Foundation's CEO next on Market Catalysts. New data out shows the number of children around the globe dying before their 5th birthday is projected to rise for the first time this century. That reverses decades of progress. Now the new Goalkeepers report from the Gates Foundation is outlining targeted investments to help save millions of children's lives around the world. Joining me now, Mark Sussman, Gates Foundation CEO. Great to see you, Mark. Thank you so much for joining us.
Thank you for having me.
So the scope of the problem is alarming, I think it's fair to say, and sobering. So I want to start there before we talk about the solutions, talk about the reasons that we're seeing this uptick in projected mortality for kids around the globe.
Absolutely. So the first bit of context that's important today is just how dramatic the improvements had been in saving kids' lives over the last 25 years. In 2000, which is when the Gates Foundation was started, over 10 million kids a year died of preventable causes. By last year, that number was down to 4.6 million, more than halved. That is the greatest improvement in human history for the largest number of kids, and it's something that we've been very proud as the Gates Foundation to help contribute to. And so having a reversal this year 200,000 additional kids dying and the first increase in preventable child mortality this century is a huge shock to the system. And it's clear that the primary reason has been the pullback of wealthy governments around the world. The US among them, but also the UK, France, Germany, Japan, the Netherlands. All of them have been pulling back from some of the international support in global health that they've traditionally provided. And sadly, that has a real impact, and the impact is measured in human lives.
Now, the Gates Foundation had already been present in these situations and is stepping in these situations. But is there anyone else to fill the gap here? Are governments in these countries able to come up with at least some of that difference in what's needed?
Yeah, so they're doing absolutely everything they can, but these are poor countries, what we call low and middle income countries, and many of them are facing huge economic headwinds themselves as a result of particularly debt crises, where the rise in interest rates means that they're now paying more. Over 60 countries are paying more in debt services internationally than they're able to spend on their health and education combined. And so, yes, we've seen countries from Nigeria to Ethiopia to Zambia to South Africa step up and provide more resources, but the scale is just different. What's been cut is in the tens of billions of dollars, and what they're able to put back in is in the hundreds of millions of dollars. Even the Gates Foundation, and our budget is going to reach $9 billion a year next year, the scale of what we're able to provide falls far short of the gaps. So what there is a big short-term challenge right now, trying to address the shortfalls, but what we're trying to do is then build long-term resilience so that over time these governments and countries can pay for these services themselves.
And Mark, you all have always been focused on sort of getting a lot of bang for your buck, for lack of a better term, that very efficient use of funds, but I imagine it's even more acute to do that right now. And that's some of the focus of the Goalkeepers Report, is how to use your monies most effectively. One of the things that you talk about that seems very deceptively simple is primary care and investing in that primary care. So talk to me about how that's sort of working.
Yeah, well, primary care, which basically is health clinics in rural or urban areas, which is the first point of contact for very poor people. If you're a pregnant mother, if you're a kid with a fever and you're worried about whether it's malaria and your parents bring you in, that's the front face of intersecting with the healthcare system. And it's pretty cheap. For $100 a year per person, you could actually tackle 90% of all childhood deaths. And that's the statistic we have in the report. And so we really are saying this is not a lot of money we're talking about. Providing the resources both directly to primary health care through partnerships like the Global Fund to Fight AIDS, TB, and Malaria, and the Gavi Vaccine Alliance, which have been two of the most powerful multilateral partnerships of the last 2 decades that we've been part of, where the US has historically been a great leader. Those are very efficient mechanisms that make sure you get low-cost treatment, whether it's a malaria bed net or whether it's a vaccine, to kids who need them, and that's what saves lives, and that's what we're calling for in the report, saying we need to double down on investments like that, and also double down on what are some exciting new innovations. There are new vaccines, for example, the RSV vaccine, which is now available for pregnant mothers, helps prevent their children getting pneumonia. There are exciting new tools in malaria. We're hoping for new advancements in a malaria vaccine that will be much more effective going forward, that can save lives, because 90% of the people who die of malaria are kids under 5. So we're saying a both and. Support the existing platforms like the Global Fund to Fight AIDS, TB, and Malaria, and underwrite these exciting new innovations, and we can actually save tens of millions of lives in the next 2 decades.
Now, Mark, just as the U.S. sort of set the tone on these budget cuts that are affecting these various countries in this child mortality, how concerned are you that the U.S. will also set the tone on vaccinations? And I'm referring, of course, to the sort of retrenchment and pullback in vaccination support that we have seen on the part of U.S. health agencies under the leadership of RFK Jr. Does that make the job of getting people vaccinated around the world harder?
So I want to be clear on the U.S. What was most challenging about the U.S. cuts was how abrupt they were. They came in, January, February, and suddenly there was a lot of confusion, and the U.S. has been historically by far the largest funder of global health. Now, since then, the U.S. and the State Department under Secretary Rubio has recommitted to global health as a top priority, which we've been very encouraged to see. They have a new U.S. global health strategy, and they did make a very generous commitment recently to the global fund replenishment. The U.S. is the largest funder of the global fund to fight AIDS, TB, and malaria, and they announced a $4.5 billion commitment just 2 weeks ago in South Africa. And so we really appreciate that, and that is very important because it will provide a third of that funding. But at the same time, in an area like vaccines, the Gavi Vaccine Alliance, which is the other partnership that has been responsible for saving so many lives and saving many more kids' lives, there the U.S. has pulled out of funding. And it was Secretary Kennedy who represented the U.S. at the Gavi replenishment, which took place in Brussels early this year, and said that the U.S. would not currently fund things based on, he was citing some studies which are not accurate studies about the effectiveness of vaccines and how they're being used by Gavi. So we do think that is a challenge, and we think that the Gavi is a signature example of traditional U.S. leadership that does save lives, and we hope and encourage the U.S. to resume its engagement with Gavi going forward.
Mark, separately from the Gates Foundation, which of course is majority funded by the Gates, I'm curious what you're seeing in terms of cadence of philanthropy elsewhere, especially with this sort of change in priorities, at the very least, of various governments. I mean, this week we got the news that Michael and Susan Dell were going to be donating $6.25 billion to seed so-called Trump funds, basically funds for kids to invest through at least the first part of their lives. And I'm curious what you're seeing in terms of priorities on the part of individual wealthy philanthropists, and also how much they're giving and whether that cadence has changed.
Yes, so I think there is a lot of energy and momentum within the philanthropic community to increase the scale and scope of giving, which we warmly encourage. So we know that Bill Gates, along with Melinda French Gates and Warren Buffett, helped create the Giving Pledge now over 15 years ago, which requires people who join are billionaires who commit to giving at least half of their wealth to charity going forward. And we have been clear for a while that we think the most effective use of philanthropic resources is giving to the needs of the very poorest and most vulnerable. There are many great causes, but we think that is the most pressing one. And so initiatives like the announcement by Michael Dell, which is very much focused on helping the poorest Americans, or globally, partnerships that we see that Indian philanthropists, for example, or South African philanthropists who we partner with are putting money into areas like education and health are critically important. And so we hope the example of the Gates Foundation, and Bill did make a historic commitment earlier this year to give his remaining fortune to the Gates Foundation, and we're committing $200 billion over the next 20 years to the causes of the Gates Foundation, which are largely education here in the U.S. and then global health and development internationally. And we hope and believe that many more philanthropists are going to step up and engage. But I do want to be clear that philanthropy will never, even at the largest scale, be able to substitute for government. Government does remain the most important funder of services for poor people, whether you're in very poor countries or very wealthy countries like the U.S. And philanthropy can be a catalyst that helps drive, that helps innovate, that helps take risks, but it cannot be a substitute.
Mark, thank you so much for your time. Appreciate it.
Great. Thank you so much for having me.
Coming up, we'll have full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets, which are not doing a heck of a lot today. We're not seeing much movement on the index level today, even though we have some big movers on the individual basis. But right now, the Dow is very slightly higher, the S&P and NASDAQ very slightly lower. One stock that is moving is Meta. Those shares are up almost 4% after a report from Bloomberg that the company is planning cuts, or at least considering cuts, of as much as 30% in the Metaverse operations, which could include layoffs as soon as January. Meta declined to comment to Yahoo Finance on this report. For more on the latest shakeup in the big tech trade, I want to bring in Brad Erickson, RBC Capital Markets equity analyst. Brad, it's good to see you. You do cover Meta. And so I'm curious about this report, right? Because, I mean, we know Reality Labs has been losing money pretty much since inception here. So is this just an acknowledgement of reality potentially on the part of Mark Zuckerberg?
We don't know if the report is true, so it's hard to say.
Fair.
But what I will say is that, I think you have to look at it holistically across the entire company. The company announced the expectation last quarter that they would spend significantly more on CapEx in 2026. Obviously, that was tough for a variety of reasons, but tough on the stock on the quarter. And so I think you look at this and you say, well, Metaverse has not been a focus for them for the last year or 2 years or so. They're clearly focused on superintelligence, the chatbot opportunity, and creating what they call kind of novel utility and use cases from this superintelligence unit. I think that's where their focus is. That's what we've kind of said to date on the matter. And so I think you look at this and you say, hey, maybe they can find efficiencies from this if the report is true, but that's our best guess for today.
Brad, I've seen some of the AI cynics out there, some of the skeptics say, okay, this is what happened with the Metaverse. This will eventually be coming for AI as well. Obviously, the spending is much bigger on AI than it ever was on the Metaverse, but I'm curious what your response would be to something like that.
I think it's kind of apples and oranges, frankly. I think with the Metaverse and, you go back to things like NFTs from, even 4 or 5 years ago. I think we can confidently say that those things, those technologies and kind of user experiences did not proliferate as some may have hoped then. I think with the chatbot, and you've seen, certainly the progress of ChatGPT and now of Gemini lately, clearly the use case is proliferating very, very quickly. And so I think you've kind of put that debate to rest, I would say, at this point.
And as you mentioned, Gemini has been gaining some steam lately in terms of more people using it. And this has kind of scattered the AI trade to some extent, right? In recent weeks, we've seen Alphabet shares certainly take off. How are you currently thinking about the sort of, arms race within AI and who could win and whether that's the way you should even be thinking about it from an investing perspective?
Yeah, no, I mean, for sure, when you think about just the history of consumer internet, flywheels, network effects, whatever word you want to use, typically you end up in a winner take most, or if not winner take all type scenario. And so, Google was our favorite idea starting out 2025. And I think, we've been pleased and fortunate to see that kind of coming together here recently, punctuated with the release of Gemini 3, which is creating new capabilities, and then obviously the ramp of AI overviews, AI mode, and the Gemini app itself. And so I think with Google having that distribution, we continue to like their potential to potentially be maybe not a winner take all, but potentially a winner take most type scenario. And that's kind of where we sit today. And obviously there's been a lot of news flow around this just even in the last couple of weeks, and maybe some of the sort of course corrections, if we can call it that OpenAI may be pursuing. Hard to sort of know what's entirely going on there. But certainly we continue to feel like Google is very, very well positioned from a consumer perspective.
Well, I mean, Google won the first one, meaning it won search, right? You could say it's certainly the winner take most, the vast majority of search. So at the same time, there were some challenges to it from a regulatory perspective. But what lessons do you think that Google can take away from that, or Alphabet can take away from that, to apply to this fight as well in terms of encouraging adoption?
Yeah, I mean, the regulatory stuff is hard. I think at this stage, where we're still very, very early days in terms of adoption of these chatbot tools, you have to try and create the best product and best situation for users that you can, and let the chips kind of fall where they may. I think, we had flagged just yesterday, Google's VP, I believe, of search had said, look, we want to create a scenario, we want to create a user experience where you don't have to go searching for different things in different places. We love that kind of a statement. We think that's very, very compelling from user experience, where people are still maybe using Google for facts and ChatGPT for other types of things. So I think they're focused on building the best product. Could there be regulatory pressure down the road? Absolutely, similar to what you just laid out with search. But at this stage of the game, it's far too early, I think, to presume or discount that.
And let's talk about the TPU side of things also, because there was a story today that called it sort of their secret weapon or secret sauce, if you will. So even if they didn't win in chat themselves, is that sort of the backstop that they're going to be selling enough of those TPUs to even their competitors that they're still going to win?
Yeah, so I mentioned there's been a lot of news flow just in the last few weeks that you're right on the TPUs. That just came out, I think, early last week. So that's been the catalyst here, even most recently. What I would say there is it's hard to call it the secret sauce when you're on almost version 8 of Google's TPUs.
It's not so secret,
this has been
in other
out
words.
For a little while. Yeah, exactly. But it is a very important piece. I think, it's hard to say, right? Like, TSMC, who kind of backstops or is the lowest common denominator on the production of these chips, they've already given their allocations to these guys for 26 and probably into 27. So it's a little bit hard to make the case from a sort of excess capacity standpoint that Google might have, or the Google's ODM partners might have, to produce these chips. But it is certainly possible and positive. I think the question we raised in our note last week around this was that, this could very well be Meta, and speaking to Meta's partnership with Google that kind of got this all going, this very well could just be Meta sort of testing the waters, trying to have a negotiating tactic with NVIDIA. And so it's really hard to know, to the extent that this really could kick in 26. But I think the bulls for Google and what the stock is telling us is, hey, we are potentially ready to bet on this in 26 and 27, really starting to hit numbers.
Speaking of a lot of news flow, we also heard from Amazon, right? And got some new product introductions and some chip news there. So how did they stack up when you're talking about all of these other competitors?
Yeah, so not a totally same situation, but
right.
Certainly, the intrigue there has been around their own application-specific ICs, their own ASICs, which is Trainium 2, which is what Anthropic has been using, and then obviously there's a ton of intrigue on how Trainium 3 will roll out, and that's a chip that they will be selling to a far bigger audience in terms of the number of companies that use that chip. And so I think the view there is power is still probably the bigger constraint for AWS expanding its capacity in 2026. Certainly has been recently, but I think people are, cautiously optimistic that Amazon can bring that Trainium 3 product to market in a bigger way and potentially, again, further that acceleration story with AWS next year.
And Brad, to be clear, from an investment perspective, you've got outperform ratings on these three guys. You don't cover NVIDIA, but when we're talking about Amazon, Alphabet, and Meta, you think that there is a case to be made for buying all three of these companies.
Yeah, certainly. Like I said, Google was our favorite idea for 2025. And it was mostly, we were sort of focused on the controversy, right? At the time, OpenAI was kind of leading the way on that. But Meta's a stock we've been pushing for 4 years since we found the sort of algorithm recovery from the Apple signal loss in our own channel checks. And then obviously with Amazon, we've kind of felt all along with this AI situation, a lot of the value creation probably should accrue to the hyperscalers, the infrastructure, the owners of the infrastructure as kind of the gatekeepers to the compute that you need for AI. We continue to generally believe that. So yeah, those are kind of the arguments around all three.
Do you have a favorite one for 2026 yet?
We have not come out with our 2026 outlook, so I'll say that again, Google has been kind of our favorite idea. And we like all three. We like Amazon as well.
Okay, we'll have you back when you come out with that outlook, Brad. Thank you very much. Appreciate
Sounds good.
it.
Thank you.
Coming up, President Trump expected to name his pick for Fed chair early next year. We're doing a deep dive into each of the candidates on the short list. Stay tuned. We'll have our profile of the next one next. President Trump is expected to name a new Federal Reserve chair to replace Jerome Powell. We're doing a deep dive into each of the 5 candidates on the short list. Fed Governors Christopher Waller and Michelle Bowman, former Federal Reserve Governor Kevin Warsh, National Economic Council Director Kevin Hassett, and BlackRock head of fixed income Rick Rieder. Our Federal Reserve correspondent Jennifer Schomburger has a closer look at Michelle Bowman and what her leadership would mean for the Federal Reserve. Hi, Jen.
Good morning, Julie. Michelle Bowman is currently a member of the Federal Reserve Board of Governors, appointed by President Trump during his first term and elevated to the role of Vice Chair of Supervision earlier this year. Like the president, she shares the view that interest rates should be lower, given what she sees as fragility and the job market. She has penciled in 3 rate cuts for this year and is expected to vote in favor of a rate cut next week. Now, when it comes to inflation, she sees a limited path through on tariffs and thinks that tariffs are only going to have a small, short-lived effect on inflation. Excluding tariffs, she believes that inflation is within the range of the Fed's 2% goal. Now, Bowman has been a member of the Federal Reserve since 2018. She was appointed to fill the remainder of an unexpired term and then reappointed for a full 14-year term that ends in 2034. Before joining the Fed, she served as the Kansas State Bank Commissioner and Vice President of Farmers and Drovers Bank in Kansas. She's also served as a policy advisor to President George W. Bush's Homeland Security Secretary and Director of Congressional and Intergovernmental Affairs at FEMA. She holds a bachelor's degree from the University of Kansas and a law degree from the Washburn University School of Law. Bowman's views align with other Trump-appointed financial regulators and the administration. She staunchly opposed former Vice Chair of Supervision Michael Barr's plan for Basel III to significantly ratchet up capital requirements on banks as much as 20%. She argued that the plan would significantly harm the economy and expected to roll back that proposal and put out a new proposal earlier next year that's more in line with the 2017 Basel Plan. She has also advocated for regulations tailored to banks based on their risk profile and size. Now, when it comes to Federal Reserve Bank independence, she says that is critical for the Fed to make monetary policy decisions independently, though she also says that the central bank needs to be transparent and held accountable for the decisions that they make. Julie?
Jennifer, thanks so much. Coming up, we'll take a look at some of today's trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama, live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and to be quite frank, all 3 major indices not really doing much, bordering that flat line as they continue to wobble as investors assess the latest jobless claims data that we got that cited that 191,000 Americans filed for unemployment benefits during last week. Of course, that shortened holiday week. Also, Challenger Gray and Christmas shared a new report that 71,000 jobs were let go during the month of November. But now today, stocks really bordering the flat line after that rally that we saw last week. The Dow up about 3.8% over the last 10 days. The Nasdaq seeing a similar return, and the S&P 500 also seeing a 3% return over the last week. But if we had to put a point in it, the Nasdaq seeing the most downward momentum today in intraday trading. So let's dive into what exactly is driving that downward momentum, and also some winners within the Nasdaq as well. Let's kick things off with Meta. That company seeing a pop today, up about 4% after the company announced that they're going to pull back some investments within their Metaverse business. That part of their business has been losing money since 2021, and so investors seemingly optimistic about that move by the social media platform. Of course, year-to-date stock up about 13.7%, and today alone up about 4%. Another stock that's in the green is one that we all discuss a lot here at Yahoo Finance, and that is NVIDIA. America. That stock up about 1.5% after Jensen Huang really made his rounds around DC. Also jumped on the Joe Rogan podcast yesterday. That was released as well. This stock, though, down more than 8% over the past month, but once again, seeing a bit of a pop today. Also taking a look at equal weighted here, we do have others within the green as well, including Dollar Tree. This pop coming off of the company reporting earnings on Wednesday, where it also raised its full year outlook. We also heard from competitor Dollar General that both did well. Year to date, the stock has really been outperforming, up more than 56% as consumers continue to seek out value. Another company I want to get to today is Netflix, because Netflix is seeing downward momentum, down about 1.5% today after it's coming out reports from CNBC that it could be the leading bidder for Warner Brothers Discovery. So that stock's seeing a bit of a decline today, but really mostly in the red when it comes to the NASDAQ 100. Some momentum coming from Meta and Dollar Tree as well. Broadcom also trying to hold on to upward momentum as well, up about 0.8% at the open. But once again, taking a step back, all three major indices mostly flat as we make our way into today's trading session. But keep it right here on Yahoo Finance, because we'll be tracking all the latest market moves throughout the session.
Now time for some of today's trending tickers. We are watching Costco, Build-A-Bear, and Symbotic. First up, Costco. Those shares are slipping after November same-store sales came in below expectations, signaling slower U.S. traffic. Though Citi analysts do say, while the market may focused on that slight slowdown in November same-store sales, overall they think the month was solid. They cite balanced gains in both ticket size and traffic and steady performance across categories. Next up, Build-A-Bear Workshop. Shares sinking after the toy retailer missed third quarter revenue estimates. Its CFO says tariffs and related costs hit the company for the first time this quarter and will continue into next year. Still, management is sticking with its 2025 guidance for revenue, profits, and new store openings. And finally, Symbotic, the AI-driven robotics company, launching a $10 million public offering of its stock. Shares are sinking amid the offering. It was announced yesterday after the closing bell. Symbotic will offer 6.5 million shares in a primary offering, and an affiliate of SoftBank will offer another 3.5 million shares in a secondary offering. Symbotic plans to use the proceeds from those sales for general corporate purposes. The bidding war for Warner Brothers Discovery, it's heating up and maybe getting a little messy. Paramount reportedly penned a letter to the company and said the sale is, quote, tainted. Joining us for more, Yahoo Finance senior reporter Ali Canal, who's been covering all the ins and outs of this mess. I think messy is a fair way to describe it. This messy story.
You could make this into a movie or a show that will air presumably on one of these streaming platforms.
I was thinking it would be a studio episode at the very least.
Exactly. Maybe an episode of The Morning Show one day. Who knows? But yes, new drama in the media world. We did see those second round bids from Netflix, Comcast, and Paramount when it comes to WBD. Now, Netflix and Comcast are only interested in the studio side of the business, that IP, whereas Paramount would go for the entire company. Now, Paramount, though, is sending a letter to WBD calling foul on the whole process, accusing the company of what it calls a, quote, predetermined process that favors a single bidder. And that single bidder, they say, is reportedly Netflix. In a letter that was reviewed by CNBC, Paramount's attorneys say WBD has abandoned the semblance of a fair transaction, and they're asking whether an independent board committee is even overseeing the process. Now, WBD lawyers did respond, confirming they received the letter, but that its board is fully complying with those fiduciary duties. So a lot of drama as we get the finish line here. Again, Netflix reportedly the bidder. WBD could pick a winner as early as next week. But if you layer in what a lot of the Wall Street commentary says, Netflix is historically a builder, not a buyer. Mm-hmm. They did hint on their third quarter earnings call that certain strategic transactions could make sense, but it's more insulated really because 63% of its content today is original content. No single title makes up more than 1% of viewing. So it's not as dependent on outside studios as maybe some of these competitors. And Citi analyst Jason Bazinet, friend of the show, he talked a lot about this, and he said he basically divides the three bidders into four buckets. One who wants all of WBD. Only one is Paramount. 2, who needs this the most? He says out of the 3, it is Paramount. 3, regulatory risk. Paramount seems to have the lesser hurdles there when compared to Netflix and Comcast, thinking back to the AT&T Time Warner fight. And 4, who can pay in cash? Netflix best positioned to pay in cash, but even Comcast and Paramount have been going out to the Middle East trying to raise all this money. It's clear that WBD wants an all-cash offer. So on the street, they're really siding with Paramount, but now we're seeing these reports that Netflix is leading the way higher, which I think would be a big shakeup and surprise when it comes to really who can continue to survive in this dynamic that keeps switching and changing within media and streaming overall. So, I mean, if we get that answer next week, there's going to be a lot more questions, I think, to come.
Yeah, I mean, so next week is the deadline? Like, what's the deadline at this point?
There's been reporting that before Christmas, WBD wants to make a decision. CNBC saying it could come as early as next week. I think it will depend on the offers and really how much more contentious this gets.
Man, what is David Zaslav's white party going to look like next year? After, I mean, he's already, one of the highest paid CEOs.
Yeah.
And once he gets this payday.
And you know, there's been a lot of consolidation already in this industry. We have the Versant spinoff that officially happens on January 2nd. That Investor Day is happening today for Wall Street. Now that's through Comcast. So you could argue maybe Comcast in their deal, we don't want to purchase the cable and broadcast properties, but maybe we could spin those off and tack that on into Versant. There's just so many scenarios where this could go, but very complicated, and it's getting a little dramatic too.
Yes. Well,
Hollywood story.
Befitting the industry, exactly.
Tale as old as time.
Exactly, appreciate it. Well, the housing market's been sluggish this year with prospective home buyers facing high mortgage rates and high prices. Yahoo's Josh Lipton spoke to Realtor.com senior economist Joel Berner about what the market will look like next year.
So let's get right into this report, Joel. So mortgage rates, you say here, expected to stay above 6% in 2026. Your forecast, Joel, if I have this right, is 6.3% average mortgage rates next year. Let's start there, Joel. Why do they stay above 6%, Joel? And what does that mean for affordability next year?
Really, we see 2026 as a year of steadying across a lot of dimensions of the housing market. Mortgage rates are one piece of that. We expect the Federal Reserve's cuts in December to already be priced into the market, and we expect stability going forward with how monetary policy is handled and how the housing market responds. And so I think this mortgage rate stability is really welcome news for folks who have been on the sidelines for the last couple of years, unsure of whether they can get into the market or not because of how volatile rates have been. So we expect 6.3% average throughout 2026 and ending the year at 6.3%.
And affordability, it improves, Joel, you think, so I have this right, because you think incomes will rise faster than prices?
That's right. We project prices of homes to rise at about 2.2% over 2026, which we think is going to be a little bit below inflation and a little bit below income. So real and adjusted price of homes will actually improve a little bit in 2026. And the improvements in mortgage rates from this year's average, which is about 6.6%, play a part in there as well.
Home sales, you point out here, Joel, they hit a 30-year low in 2024. You think they improved slightly this year per your forecast. What happens in 2026, Joel?
2026, we're projecting a 1.7% increase in home sales, getting up into the 4.1 million range. Still pretty subdued from what a couple years ago were, but not down to the 30-year lows that we've been seeing in 2024 and 2025. So really, it's a little bit more of the same, just slightly steadying and a modest improvement in home sales volume.
What about inventory, Joel? I'm curious what you forecast next year. Are buyers going to have more options?
Buyers will have more options. Across the country, we project an 8.9% increase in the number of homes for sale. And this, of course, isn't uniform across the country. In different pockets, in different markets, we'll see inventory rising and falling at different rates. But overall, more options for buyers to choose from, less competition, so more negotiating power for buyers.
You point out, Joel, I mean, there are regional differences. Are there certain regions of the country, Joel, you all expect to outperform next year?
A lot of our strongest markets are in the Northeast and Midwest in terms of projections for 2026. These are places where we expect sales volume to grow and prices to grow because inventory is more constrained. While in the South and West, inventory recovery has been a lot stronger. There's more new construction activity, and so more competition among sellers will keep prices a little bit more affordable and attainable, while in the Northeast and Midwest, we expect more growth.
So some improvement next year, but what are the factors, Joel, the biggest factors that you think would be holding the housing market back? I mean, would it be, is it rates? Is it prices, the economy? Walk me through it.
Rates and prices are for sure to blame in terms of what's holding the housing market back this year. But really, I think uncertainty surrounding the economy in general is really holding people on the sidelines. People who are worried about their jobs are not looking to make giant purchases like a new home. And so I think anything that can be done to assuage those fears and build up consumer confidence will really go a long way in boosting the housing market in 2026.
A question for those who rent, Joel, and maybe watching this. You say rents expected to decline slightly by 1% next year. You say, a question that's sort of astral, is renting more financially attractive than buying? You'll hear that put out there. That's a discussion point. As an economist, how do you try and think through that? What are the variables?
The most important things to think about are the time horizon and whether you consider being able to live in your investment valuable or not. Based on our price projections, that putting money into the S&P and renting might be a good way to get returns on your investment. But getting your foot in the door for home ownership is important for renters too. It's been especially difficult for first-time home buyers in recent years with mortgage rates remaining high. Those who don't have equity from an existing home have to save up what they can from their paychecks to make a down payment on their very first home, and that's been a challenge. So I certainly don't blame anyone who decides that renting is the right thing for them right now, but this should be another year of rent declines and a good time to save up for a down payment in the future if that's what your goals are.
Fine, Joe, just talk to me about the role the Fed plays here. The expectation is, the cuts continue. How does that play into your forecast?
Right, our forecast is mostly built on economic inputs like GDP for the various locales that we look at in terms of employment, because the labor market always underpins the housing market. But the Federal Reserve is something that we keep an eye on, how they're behaving and what we expect out of them. Like we said a little bit earlier on the show, that the December rate cut is pretty well priced in already. But we're interested to see what the chairman and the FOMC has to say about the longer term projections for rate cuts and whether those will give mortgage rates room to even get below our projections. We're in the business of selling homes, so we'd love to see those rates come down.
Coming up, Consumer Reports has issued its report card for the auto industry's top brands. We'll give you the details next. And don't go anywhere. After that, we're sitting down with the CFO of UiPath as the stock soars following its earnings report. You're watching Market Catalysts. Consumer Reports is out with its annual report card for automobile brands. Yahoo Finance senior autos reporter Pras Subramanian is taking the wheel and joins us now with the rundown. So what do we need to know from this list? What is top rated, Pras?
So Subaru and BMW top the list again. CR says they're the best auto brands overall. They use their own independent reviews. They have a huge test track in Connecticut. They buy all the cars. They have hundreds of thousands of consumer surveys that they have, and over the course of 20 years, right? They're polling both new and used car owners. So Subaru excelled in both performance and comfort. BMW outshined, they said, other luxury rivals in reliability. Now, interestingly, in the overall rankings, Tesla came in at number 10. A little bit more on them later. And on the flip side, Dodge, GMC, Land Rover, Rivian, and Jeep at the bottom. Jeep remaining there for the last couple of years now because of issues they've had. Now, in terms of overall reliability, this is one component of the whole score. Toyota to the top spot, followed by Subaru. But interestingly, Tesla hit number 9, its highest ever level, with CR claiming Tesla's Model Y and Model 3 quote, overcame build quality issues from the past, right? So lots of interesting findings in the report. CR, I mentioned, is the gold standard here when it comes to auto reviews and polling their survey members, see what are the best cars. And it's sort of who I would point to in terms of people looking for a new car. Here's what you should do. Look at these results and pick the kind of car that suits your needs.
They also had a few things to say about hybrids, which I think is really interesting here. You talked about reliability being one component of the score, and I guess hybrids are pretty reliable according to them.
Yeah, hybrids in the past had issues with the complicated, powertrain situation with the battery and an electric motor augmenting the gas-powered motor, issues with that. But those are sort of kind of gone away. And I think there's a percentage, about 15% less, fewer problems with these hybrids, CR notes. But one thing that's also interesting is pure EVs. And they're saying that owners are struggling there with reliability. In particular, the GM Ultium EV platform having a series of battery failures and climate system issues. They don't have enough data to suggest that reliability is improving, but overall EV reliability across all the different kinds of brands is stabilizing, they noted. So, and this despite new EV models coming into the market kind of at a rapid pace. So there's some changes there, some improvements with hybrids, and EV still trying to catch up.
Yeah, that's really interesting. All of the stuff on EVs, I think. But also, you mentioned Tesla's kind of cracking the top 10 in terms of reliability, but it's a different story if you buy a used Tesla, not a new Tesla.
Yeah, well, so Consumer Reports looks at cars from the 5 to 10-year-old range for their used cars. And back in those days, it was really the Model S was the only car they had, and it had just come out, and still, and now 10 years later, it's still suffering from a lot of old issues for a car that, if you come out a new car that they did just built a new manufacturer, 10 years down the line, you're going to see some problems there. The Model 3 only came out in 2017, 2018, so it's not even that old yet. And the cars that they first made suffered from a lot of fit and finish issues, some quality issues, and we're seeing that come up. But apparently, the newer Teslas are in better shape.
Oh, was there something on the list that surprised you the most, Pras?
Yeah, one little thing that I saw was Rivian, right? Rivian was kind of low in the overall rankings, and they were dead last in reliability, right? So not good. But they had the highest number of buyers would buy another Rivian if they could. And CR sort of explained that being the fact that these people who buy Rivians are okay with the tech growing pains as long as they get new technology. They're willing to suffer that because they love the product, they love the tech, they love the cars, and I guess sort of the adventure spirit is there, and they're willing to take the chance and deal with some service visits.
That is really interesting. Pras, thanks so much.
Thank you.
Wall Street is increasingly focused on a new question. How is the global AI tab actually going to be paid? For a while, the big hyperscalers have been funding the build out with tons of cash on hand, but reality and expectations, they are shifting now. More and more of that bill is likely to come from new debt, and Oracle is already there. It is borrowing to build AI data centers, and the cost to insure that debt has spiked. That insurance is called a credit default swap, or CDS, and that's what we are breaking down on today's Stocks in Translation. So let's start by breaking down the CDS, which you might remember from the global financial crisis. You can think of a credit default swap as a contract that protects an investor against a company not paying its debt. The buyer pays a yearly fee, like an insurance premium. If the company stops making payments on its debt, files for bankruptcy, or otherwise defaults, then the protection seller has to cover the agreed upon losses for the bondholder. To put it simply, it's just insurance on a corporate IOU. Now, how does this work in practice? Say an investor owns a company's bonds and wants protection. They go to a bank or a dealer and pay a fee each year to insure those bonds. If Oracle runs into serious trouble or ultimately defaults, that CDS contract pays out and helps make the holder of that bond whole. And this is key. When that yearly fee jumps, it means insuring Oracle's debt just got riskier and more expensive in the eyes of the market. And that can be one of those canary in the coal mine signals. Now let's take a look at how all of this is playing out across the big AI players. This chart shows the annual cost to insure $10 million of 5-year debt for Oracle, Meta, Amazon, and Microsoft. Now focus for a second on that top line, which is Oracle. Since the summer, the price of protection has climbed sharply. Meanwhile, Meta, Amazon, and Microsoft, the lines in the middle and lower part of the chart, they have been much calmer, but they're also rising too. So credit investors are basically saying we're more worried about how Oracle is funding its AI push than we are about these other hyperscalers. But finding CDS data isn't always cheap or easy. So let's bring this back to something that you can actually see every day. Here in this next chart, we have Oracle's stock price in blue and the price of its long-term bonds in white, both since the beginning of the year. Now notice how they track each other pretty tightly and they tend to move in the same direction. And always remember that bond prices, which is what we're showing, move in the opposite direction of bonds yields, which is what we're not showing. So when the stock climbed through the spring and the summer, the bond price was generally moving higher too, which means that the yield on that bond was going lower, indicating less stress. And when the stock rolled over and quickly dropped after the September peak, the bond price also fell. That means the yield surged higher, and that indicates more stress. So even if you never look at a corporate bond or a CDS quote, a big persistent sell-off in a company's stock can be a sign that credit investors, they're getting nervous too. So here's what to watch out for from here. Oracle is less cash rich than the other hyperscalers, so that's our canary. So if you have access to Oracle's bond and CDS prices, you can see how they track with Oracle's stock price. And if you don't have that market access, know that any large or long prolonged sell-offs in Oracle stock is also a big warning in itself. Then track how much new debt Oracle actually issues to fund AI data centers. That'll show up in headlines and earnings calls. Next, see if debt and insurance costs start rising for other AI hyperscalers. And if you don't have the data, you'll see the big moves in headlines or just watch for the big drops in stock prices. And finally, watch those hyperscaler earnings reports, particularly on AI and cloud profits versus their interest costs. We want to know if all those new data centers are earning enough cash to comfortably cover the interest bill. Bottom line, Wall Street is honing in on the great AI build-out tab, and now that they're paying attention, so can you. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Shares of software firm UiPath soaring after the company's latest results. It topped expectations with third quarter results and gave upbeat guidance. Joining us with more, Ashim Gupta, UiPath CFO, is with us. Ashim, thanks so much for being here. Let's talk about the third quarter because it was your first profitable third quarter. You saw enterprises accelerating their spending on your automation software and strategies. So do you see that continuing, that profitability trend?
Yeah, absolutely. Look, our teams are executing at a high level. We had an incredible quarter that was marked both by the innovation that we're putting into the marketplace and customer responsiveness, as well as really good discipline in investing in areas that are needed for our future growth, but driving efficiencies, including agentifying ourselves internally. And when you put those two things together, we're really excited about both the fourth quarter and next year, being able to continue the momentum that we've been seeing in the third quarter.
Ashim, can you explain for folks kind of what it is you do in terms of that automation process and sort of how that is different from or complementary to the AI wave that is affecting almost everything?
Yeah, so UiPath provides an AI-powered platform that helps organizations streamline and transform their businesses. What that looks like is taking advanced AI capabilities, software robots, and process orchestration, and taking processes that are as simple and as common as accounts payable in enterprises to really specific processes that are highly complex, such as claims denials in healthcare, and taking the manual work out, increasing accuracy, and reducing the cost of transactions and overall the cost of those processes to customers. For our customers, that means that they can invest in innovation. So that is what we do. When you look at how we are versus other AI waves that are there, I would say we bring the ROI to a lot of the AI capabilities that has hit the market. So when you think about large language model capabilities, we integrate with a lot of the large language model companies that are there. So their models can be used to read documents that are used in these manual processes today to automate them. We infuse our platform with a lot of the AI capabilities such that you can orchestrate a process and run agents in a safe and trustworthy way using our process orchestration so you can monitor them. So we're very complementary, and the key thing for us is taking the language of AI and really making it have a tangible return to businesses so that they can underwrite their next waves of growth, both in revenue and in earnings.
And a couple of months ago, you all signed a new partnership with NVIDIA and with OpenAI. So how's that working, and do we yet see the fruits of that in the quarter?
Yeah, when you think about the partnerships, I think the first thing is the partnerships are a real staple. That UiPath, our bread and butter 3 years ago was around deterministic automation and RPA. But these partnerships signal that we are a real player in the AI space that is there. So I think from that standpoint, the results in the marketplace, it's noticed by customers. It's noticed by CIOs and CTOs and CFOs that are there. The second piece is those partnerships are foundational capabilities that allow us to bring the promises of AI into processes. So our integration with companies like OpenAI allow us to take their models and bring them to the forefront of claims processing within healthcare or loan origination in financial services institutions. In terms of how we see that play out in the future, I think these partnerships are going to enhance our technical capabilities. And by doing that, the more ROI you can drive, the more revenue you're going to drive. We see that with the 16% revenue growth this quarter as people are seeing us as a long-term part of their architecture. And we see this as just gaining momentum over the next quarters and years for us.
So Ashim, it doesn't sound like you guys are seeing any kind of hesitation or slowdown in enterprise spending.
No, I would say the environment is different than 5 years ago. I think 5 years ago, there were innovation funds and there's different things that are there. What I would say, it's not a question of slow or fast. It's a question of more discipline and more scrutiny. But where we feel very well positioned for that is the discipline and scrutiny is really saying, what is the return on investment? So when you can take a cybersecurity firm and transform their processes to get them millions of dollars of savings, that unlocks millions of dollars of funding for us, right? So I think that there's discipline, there's scrutiny, but I think that actually provides for longer term sustainable growth versus quarters where you get a sugar rush of orders that comes in. So that is really what we're seeing in the marketplace. It's not about the levels of spend, it's really about the discipline by which funds are being released.
Ashim, you mentioned that you guys are sort of going agentic internally also. And I'm curious what effect that is having on your hiring cadence, or are you even trimming your workforce at all?
Yeah, what I would say is it allows us to invest where we want to. So there are processes that we do today that we will not be doing with humans tomorrow. That is a fact that exists not just for UiPath, but I think for the entire world. At the same time, we are investing in engineering capabilities. We're investing on more people that are customer facing that allows us to be on the ground delivering the value to our customers while our product and engineering teams are innovating upon. So our internal agentification is really meant to do internally what we're doing with our customers. And that means moving our capital allocation and our human labor allocation, which to me is the richest source of capital in the world, and using them to drive higher quality outcomes for our customers.
Ashim, thanks for your time. Appreciate it.
Thanks so much.
And that's it for Market Catalysts. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.